On today's interview, we have Ferg, aka Trader Ferg on Twitter, investor and trader in commodities, mostly in the energy sector. I think one of the best accounts to follow for investment philosophy and mindset on Twitter, and someone I've been following very closely who just really has an amazing story. I first heard your story and I was like, I'd love to have that guy on because everyone's an investor that watches this, whether it's precious metals or commodities, and you have a really cool story of basically you were working wealth management and you didn't like it. And you were like, I'm going to take my life into my own hands. And for the last 5 years or so, you've been full-time investor trader in commodities and originally from a farm in New Zealand.
Yep, no, off the farm in New Zealand. That's where I grew up.
So was I right on the story? Like before we
Yep.
talk a little bit about investment and stuff like that. So basically you just realized you wanted to do it on your own and something just hit you and you were like, all right, I'm going to make it happen.
Not really. So it started off with just thinking I knew what I wanted. So when I went to university, I was 100% sure I was going to be a farmer. Like I was off a farm with Dad. Dad's always farmed. He loves it. I thought I loved it growing up. And then after the first year at uni, just decided no. I thought there was a lot more out there in the world. So I decided to go into property management. And then that led me to Australia. And then that led me to asset management. And then I thought that was like the life I wanted, like a suit, a corner office, high salary. And after 3 years in that, found I was miserable again and got everything I wanted. And yet it was never been more miserable. So that was when I was lucky enough to run into another New Zealander who was a hedge fund manager and managed to sort of harass him for about a year to become my mentor, and eventually he agreed, and then he's been mentoring me for 7 years now. And it was about 4 or 5 years into the mentorship that my trading got to a point I was like, I don't actually need this salary and this sort of pressure and stress from this job. I'm gonna give it a go on my own. And so I left my job just before my 30th birthday, and I had one or two people that wanted me to manage their money. So I did that for another 2 years and moved to Europe and lived in Europe and in Berlin for 2 years. Yeah. And then after that, I just it was the stress again of having to answer to people and having them ring up daily to say what's going on with this position or that position. And after a while, I was like, this isn't really fit driving with me either. I like, as you've probably seen from following me, I love really hated positions. I like going in and picking them up when everyone despises them, and that doesn't really fit with a lot of investors' psychology. And so I've found it's best just to do it on my own. And so that's been the last 3 years now. I've found myself living on the beach in Bali and doing my own thing, and I've never been happier. And that's pretty much my story to date.
That's a cool story. I love it. So let me ask you then, you said what changed your life, it sounds like, was a mentor, right? A successful
Yes.
mentor at what you want to do. And so we didn't talk that much off air, but that's something that's changed my life too in business.
Yeah.
And then also as I've gotten into investing in a different sphere, and I can count on a million hands how it's changed my life. But I'm curious, what are the things as it pertains to investing and you being full-time now and you having your pretty clear mission and purpose and investing in commodities, and we'll go into that more. But what were some of those things that you learned right now that you think are game changers for you?
So my investor, Brad, so he's got a very clear set of principles of how he goes about stuff, how he's always looking for what he calls asymmetric payoffs. So he's got this whole philosophy around you want to position yourself to get lucky. So it's the idea that you're going into something where you work out the downside, you're comfortable with it, you do a lot of work on that angle, and the upside is it's got optionality. So if you're right, you make an awful lot of money. If you're wrong, you've worked out that you've got a limited downside, you've position sized it correctly, And you just repeat this process day after day, the percent of the portfolio here, percent of the portfolio there, and you just naturally set yourself up to have a good outcome. And that's really what I've been doing and reaping the benefits from for years now. And it's just like as one that I've seen, we've discussed on Twitter was Centris, which was at one point that was 2-3% of my portfolio. It's now up there pushing 15-16% of the portfolio. And so you just have these that you just let them get away on you. Whereas, have you say in offshore, I went in early with 2-3% of the portfolio, and some of those companies have gone into a Chapter 11, so they're a wipeout. So you put those two positions next to each other. One was contained at a 3% loss, and the other is now approaching sort of a large percentage of my portfolio.
Interesting. So I'm 29, and what really I was just focused on my business, and what really attracted me to investing is I'd run my business well, and I was saving a lot of my money, and I had never invested the capital. And then first what got me interested was precious metals. But then as I've been following people like you and just kind of getting interested in the asymmetrical trade, I guess, I've never heard that term, but I think that's really what's attracted me to silver. Like silver juniors is where I have a lot of my focus, and learning from you in uranium and et cetera, et cetera. But would you say all of your focus right now is on asymmetric in commodities because you think that we're headed into a huge commodities bull market, and that's the central focus of your risk of your asymmetrical investments? Because didn't you say you're primarily coal, your energy in coal, uranium, and natural gas and tankers, right?
Yeah. Yes, I'm just a big opportunist. I'll go anywhere if I see maybe in another 5 years I'm focused on some sort of option arbitrage, or I'm focused on banks. Also, like, I really don't mind where I go. It's just where I see value and where I think I can have an edge with the thesis. And with energy, like, some of these are just going to be once in a decade opportunity because they're structurally set up for boom and bust. Like, uranium's a super interesting market when you consider that demand is actually knowable. You have 440 odd reactors out there in the world that all have requirements that their contracts are rolling off in the next few years. You can model that out. You can model how many pounds are out there, and it's unlike anything else in that you can just see this big wall of price insensitive buyers coming. And if time is on your side, you can then position for these price insensitive buyers to come at some point. And that's what just really attracted me. And since then, I've been trying to replicate the same trade across different areas of the commodity spectrum. Like, where can I see that it's going to be a when, not if situation, as Rick Rule likes to say. Yeah.
How much of your portfolio is in uranium? That's something I just did my first uranium interview on this channel. I haven't published it yet, but I think that was where I first started following your work and Centris, et cetera. Well, how much of your portfolio is in there for starters? And I'd love to talk a little bit more about your thoughts with it.
Yeah, so it's pushing 40% now. So
Okay, a lot. Yeah.
I try not to I've got a rule, I try not to let anything go past 25. So it's usually quarter, and split it up in that way. But when I keep seeing value, and especially in March, I really put the foot down there. I've done the work on companies and then just saw some prices I never thought I'd see. I really increased the weighting then, which has been quite rewarding now. But generally,
you probably crushed it at the bottom of March. Are you still as bullish as you were before? Did what happened in 2020 with government shutdowns make you more bullish than you were before? What was the deciding factor to put 40% into that? And do you think that there's still, it's been a really nice run the last, whatever it's been, month or so of a lot of these stocks. Do you think that's, there's more of that coming, or do you think we need the spot price to start to move up to really get, a next really big type of leg, like they say is legendary with the uranium market. And like you said, is a boom or bust. And if you catch the right side of the boom, it's life changing. So what are your thoughts on all that?
Well, to start with, it's a far better setup than last time round with uranium. So just the simple stat is, if you're a fuel buyer in the uranium sector and you were looking out 5 years from 2005, you would have been looking at a 72 million pound surplus, and it would never went into deficit. If anything, it actually bumped up a little bit for a few reasons, and we know how that played out. The boom that happened. Play that exercise again now. Look out 5 years, and consensus is 25 million pound deficit. I think conservatively, you'd have to say it's at least 35 to 40. And I just saw some work released from an analyst that is pegging it in the high 50 deficit. So when
50,
we know what
50 million pounds?
Yeah, it was about 50, 56, 57 million pounds.
Global annual?
Yeah, global annual deficit. So we're obviously already pushing to the extreme of, if we know, 72 million pound surplus at the start of the last bull market. And now, if that figure is correct, we're almost have that in deficit, then that's quite something. And so that is likely to set up for an absolute monster of a bull before that can get rectified. Because at the moment, if you go around the world and look how much actual production there is at the current spot price at like mines that have an all-in sustaining cost below about 50, then below today's spot price at 33, it's only about 46% of global annual demand can be met, can be produced. And most of that, they're not actually making a profit. So the simple question is, where's the other 56% going to come from? It's a lot of uranium. And the simple answer to that is it has to be incentive pricing. You have to have uranium go significantly higher so that a lot of this production can be incentivized to come on. And it's not easy to bring uranium on either. Like if you go back through a lot of the prior bull markets, a lot of people promised a lot and very, very few delivered. Like I believe the stat is in the last bull markets, you only had, I believe it was Paladin that actually delivered on taking a mine from development to production, unless they had assistance of a major, unless they got bought out and taken under the wing. Yeah, so no, it's a great setup, and that's why I talk about it a lot. Highly bullish on it. Yeah,
it's fascinating. I'm not like some numbers guy, and like I'm not like but I'm not too dumb to be able to look at black and white supply and demand fundamentals, which are like hit me in the face, just like being on the surface of understanding. And it's really exciting because they still are super cheap. But why do you think the spot price hasn't moved yet to meet these really bullish fundamentals?
So spot price is largely a bullshit market. So it's a lot of it's just traders trading back and forward pounds. Like it's not actually it's not where any of the long-term sort of uranium pounds the utilities go. Like 80+% is done via term contracting. And the weird thing with the uranium market is a lot of these have non-disclosure clauses when they make these deals. So there could be deals going on now for $50+ a pound, and we just don't hear about them. That'll be the really big point in the market when someone announces a 50+ sort of pound term contract being signed, because then everyone can immediately understand that the likes of a lot of the mines and care and maintenance can come back on, and that really does sort of signify that the utilities have come to the table and sort of said, yeah, we need to start paying higher prices. And then as that starts, it's like a game of musical chairs, because as I said before, we can only fill roughly half of demand with all the the current production out there. So they're going to get increasingly panicked as they sort of work through all the production and people start holding out for higher numbers. And then there'll be a point at which they literally contract all the available production, and then that's when things will get really interesting.
So similar to what often happens in the precious metals market is there'll just randomly be some announcement that, on a Sunday, and all of a sudden the price is just like, holy crap. And it starts to move. And I was listening, it's so volatile. And it made me think about what you said. If like there was some announcement that, hey, there's this $50 contract that could, in the equities, that could probably, because there's probably a lot of people sitting on the sidelines still waiting to see the spot price move before they really get in, because it seems like a lot of people have had a lot of ups and down heartbreaks. So that's kind of exciting, huh?
Yeah, well, it's just, you remember you can't get into this. If you're a hedge fund or any sort of institutional money, you can't get into the space very easily. Like I've got a few examples. If you look at Forsyth Metals, which is it's just a small junior. So someone tried to buy 200,000 of on the open, I believe, or tried to allocate it in a day, and they moved the stock 36%.
Whoa!
So yeah, the same with Deep Yellow. And in September, you can look at the stock chart. Someone tried to buy 700,000, and they jumped the stock 27%. So if you're a hedge fund and you've got 500 million or something, and you're just trying to allocate 1%, you have a tough time getting into any of these without just absolutely skyrocketing the price, which is why the sector is so interesting as well. Because the entire sector, probably a bit higher now, but it did have about 12, 13 billion market cap, and like Tesla trades that in a day. You've got, if people really want into uranium, there is just not the space, and it's just going to cause some absolute tremendous upside volatility. And the thing with it is what we've seen now with just the small majority of people trying to get in early, it causes like reflexivity, which is kind of like a feedback loop. Like if people get in, causes the price reaction, more people do the homework, decide they like the thesis, more people want in, and that feeds on itself. And on top of that, you've also got the fact of people have a memory of what happened last bull market. And so this is all just creates one big feedback loop of people just wanting into something that's leaving the station. So I do believe we'll see higher highs, not to say we won't have some vicious pullbacks as always do in these sectors, but I think we're going to probably see higher highs moving forward.
Yeah, it's definitely exciting. So where do you, I guess, okay, so like I did all these interviews because for my own, when the lockdowns happened, I have an online business and brand, kind of a different niche, but I started all these for my own learning because I was like, it seems like there's a great opportunity in these commodities. It seems like the bull market's getting going, and, listening to people like you that say like, basically, everyone plans for like 50 years of investment and one day they'll retire. But if you hit things that are unloved, that have crazy upside at the right time, you could cash out of the matrix and out of the system in a pretty significant way. And so I started the channel to try to basically like almost really get mentorship on these types of things. And I think then out of that, my question is, so I probably got 30% of my portfolio in uranium. And I was thinking, watching this happen has been exciting. And I think there's a lot of people that have capital available, maybe sitting on the side. Where do you stand on, are you all in right now? I know you probably were because you swept up so much in March, but what would you be doing right now if you saw this opportunity and you wanted to buy more? Would you be waiting because the spot price isn't moving with the equities and waiting for another pullback? How would you be handling the whole thing, and how would you advise someone to?
Yes, that's a tough question for me because I buy stuff when it's hated. So I just sit back and I like to get absolute bargains. So at the moment, I'm not even talking about uranium anymore. I'm talking about offshore drillers that are literally coming out of bankruptcy and have completely restructured their debt. I'm talking about coal. Like I don't chase. That's my main thing. I literally all my positions that I get filled are putting in buy orders where I would absolutely do a little dance around the table when I get filled, because I know like in March I almost don't have the stomach to go in and buy at the market because I just feel too sick when I see like my favorite stock like Paladin trading at 4 cents, just absolutely like turn my stomach knowing how much I'd put in the previous day and knowing it had traded down another cent. Like there's just, you can't let your psychology get in the way. And so, yeah, at the moment it's, I wouldn't be chasing. I'd be waiting for a pullback if you didn't have exposure, and be considering some of these other where you can get in at the real basement levels. Like I have a whole thesis on offshore, I have a whole thesis on coal, and I think if you get in at basement levels, you could experience a far better return than sort of jumping in when some of these stocks have already like been multi-baggers already. It's the price you pay is everything really. And I think a lot of these commodity spaces are going to have similar payoffs if you get in when it's absolutely hated right at the bottom and can just sit on it for a few years.
So I have like one or two coal picks from following you, but you said you have a whole thesis on that. Is your thesis affected at all by if there is in January, if a Democratic administration that's, pro Green New Deal and all that does, and is, the hardcore environmentalist, do you think, is your thesis affected either in uranium or coal or offshore drillers, because it's all kind of energy focused?
Not at all, really, to be honest, because we have this kind of media and everything at the moment. We're very focused on what's happening in developed countries. So to take you bigger picture, developed is about 1.3 billion people. So we're actually the minority, especially when you consider we've got terrible demographics moving forward. If you go to the developing world, you've got 6.5 billion people who are on the way via population growth to about 8.5 by 2050. And so when you consider that alone, just them maintaining their energy needs, that grows the entire energy system by 50%. If you consider that they increase their standard of living, say at the moment, developed countries are 13 barrels of oil per person per year, and then you consider developing 3 barrels per person per year, or if you assume that they manage to get to 4 barrels per person per year, then that doubles the entire energy system by 2050. So the story really is how to capture the developing side of this, and that's where we get told coal's in terminal decline, and all they're showing you is generally charts of Western countries and US shutting grids, but the actual picture globally is there's an additional 11% of the total coal fleet under construction as we speak. There is another 17% planned. So if you take those numbers,
total another 17% of total production or demand for
total
coal?
operating coal plants around the world.
Got it.
So so pretty much under construction plan, you're adding a third to the entire operating coal plants around the world, and most of this is in China. So just to give you a way to conceptualize it, and all of the coal plants in Europe are about 50,000 megawatts. China's building has double that under construction currently, and if you add what they've got planned, it's 4 times that. You have the equivalent under construction in India, and you have again the equivalent under construction in other Asia, which is Indonesia, Japan, and it's just South Asia in general. So it really is a growth story, even though in the West we like to label it as terminal decline. And so where the thesis gets interesting there is the fact that we're trying to essentially ban coal. We're cutting it off from capital. Like ESG is the idea that you're going to starve it of capital so it goes away. And when you do that with something that the demand's growing, all you do is kind of build a moat around these businesses, because you're not going to issue new licenses. the guys can't raise capital, so they can't expand. So they just essentially have to continue to have high cash flow because they're doing well and they can't expand their businesses. So I'm not sure if you're familiar with tobacco stocks. It's a similar sort of thing played out there. Whereas if government restricts, bans all competition, and there's still the demand aspect, then and no one can really invest in the sector because of the ESG mandates. Pension funds can't come in. Most you can't be included in the index. You get a business which is still generating high cash flow but can't be bid up. So you just have a cash cow, and that's what I'm trying to capture with coal. I think coal is a far longer trend than what we're looking at with uranium, precious metals. I think those will be very boom bust. But coal, because people can't enter the sector because they're being kept out by mandates, it should be a far longer bull market.
Interesting. So I never heard anybody talk about coal before you. And then another guy I follow, George Gammon, was talking about it. And so I have a position in the KOL ETF, and that's done pretty well in looking at the long-term chart. But when I listen to you talk about it's a little bit mind fucking to me, because I never thought about coal. And then I grew up in Southern California, and that's the most liberal of renewable. And then I never thought about the dimension of you're playing the developing world, not the Western world. And then kind of the growth storyline reminds me a little of uranium in that, there's a lot of people saying uranium's done. But when you look at the data, there's all these new mines coming on, and the production and the demand's going up for it, but the production's going down. And it kind of sounded like coal in that you said there's all these new coal plants that are coming online in developing worlds. And so that's pretty fascinating.
It's even bullish in the US at the moment because of the underperformance of gas. So the EIA just came out and they're actually forecasting gas to drop. It's going to miss its targets for next year, and they think coal's going to pick up the slack. And that's just the sheer point of shale underperforming. Like shale is quite important to understand, considering just how much of oil production, like 90% of additional oil production over the last decade was from shale. And I think that space is really in trouble and is going to underperform moving forward. And there's going to be all sorts of knock-on effects of that. And one such effect will be that coal will probably hang around and grab some of that market share from natural gas as gas gets more expensive. It's kind of like a relative play.
And how are you investing in coal? I understand what you're doing in uranium, and I know you're big in Paladin, and I followed you into that, and you're big on Centrus. But what's the deal with playing coal?
The coal's difficult, so I've had quite a hard time trying to handicap some of these companies because you don't know their ability to roll their debt, which is the big one for me. So you had the likes of Peabody Energy last time round, which looked fine, looked like had the cash flow to go forward, and then they simply couldn't roll their debt and had to declare bankruptcy. And then they had a similar case just a month ago, and I was trying to work out what's going on there because I love to buy these things when everyone thinks it's going bankrupt. But there's too many games going on with activist investors. You don't know who's pulling strings behind the scenes. So I'm really coming to the conclusion that it's just a basket approach. Coal, the ETF, is probably the easiest way, just to put that and collect the KOL, yeah, and just reinvest a dividend. Otherwise, probably what I'll end up doing is a select basket of some Aussie coal plays and some of the US coal plays. Probably minimise debt just to try and protect against this, what we're seeing now, that they just have a super tough time getting refinanced because, as you've seen, all the banks and everyone just stepped away and said, no, we want nothing to do with coal anymore, especially thermal coal. And so that's pretty much where I'm at now.
So the fact that no one will invest they're staying away from it actually makes you more bullish. It doesn't make you. I mean, I guess if you own and you're that's why you're saying the plays of the ETF, because you also limit some of your liability. But I was looking at the charts. So 2011, it got to 500 US dollars. Is at 95 now, and it got to 574 in two. That's a big run. And that's what you're saying. You think it'll be even bigger because it's so much more important because there's so many there's such a need in the developing world.
Yep. No, coal demand's going nowhere, and it's going to stay interesting, as I say, because you can't have funds, institutions, indexes, pensions. They can't chase it. They're not allowed into coal. They have ESG mandates. They have to please their shareholders. So you could see these guys having a 10, even a higher % dividend that just doesn't diminish because the only people that are allowed into it are essentially people that don't have these ESG mandates.
Interesting. And that's what happened. That's the deal with tobacco. I do remember listening to George Gammon say it's like the best performing ones because their dividends are crazy, right?
Yeah. So you can bring up like BATS or British Tobacco, any of those, and you can see they were just monster trades from the 90s for decades. And that was before you even took into account if you were reinvesting the dividend. If you reinvested the dividend on top of the capital gains, those were just absolute amazing trades.
So to get, go ahead. Sorry about that. Please go ahead.
And because what no one ever considered with them is when you essentially ban competition, like with tobacco, you were banned from even advertising it, which is pretty fascinating when you think you can't actually have any competition anymore. If they can't actually put it out in a shop, like it's actually behind the cabinet, how are you supposed to launch a new tobacco brand to compete? Yeah. You can't. So these guys had an absolute monopoly from the second that everyone thought they were dead by being cut off from advertising. It was fine. People didn't understand the demand aspect. Yeah, and I believe you will have something similar with coal.
And so I understand the uranium price dynamics in the spot price and the contracts and the supply running short. What in kind of short summary for instance, to get that ETF to move and to really, which it has, but for it to really, and those companies within it to really move, do we need the spot price to start moving in a supply squeeze like what's happening in uranium, or what needs to occur in that to, as you said, you believe it may even present a better bull opportunity than even uranium? What needs to occur for that to happen?
Well, to be clear, I'm talking like decades of coal. Coal, I don't believe will be. It could boom and bust in the same way, but I don't believe it will because you can't have the sort of the big capital chase it. It's a big question at the moment. Is ESG capital going to try and chase uranium? If that happens, things will get really nutty. Whereas coal, I really don't think you'll see the boom bust because you just can't have large capital chase it because they're not allowed to. So with coal, I think it'll just be a very slow, steady climb over time because you've also got to remember someone's just almost disgusted if they hear that you've got a good percentage of your portfolio in coal. Like I had a tweet the other night that I've talked about a few times and people messaged me, that's morally indefensible. You're talking about coal. And I just, so I had a tweet that it was like, I think it's morally indefensible that you're trying to cut off coal when there is no economic alternative in developing countries. You can't, we've seen how renewables do in the likes of Germany. They've got the most expensive power in Europe. You've seen how it's working in California. I managed to pass a tweet off the other night that I said California had one of the most unstable power grids in the world, along with Burkina Faso, Mali, and Nigeria, and no one batted an eyelid and said, source please. Other than a few were like, that's unbelievable. And it's quite something when you can say that about one of the wealthiest, I believe it is the wealthiest state in America and probably one of the wealthiest states and countries in the world, or states in the world in terms of wealth per per person. Yeah.
It's a top 15 economy if you compare it to countries in the world, California in and of itself. So that's and it's wild to think about it. I've said that to my wife before, not as it pertains to coal, because I've really only thought about it more recently as you've been posting more about it. And it's, got me really interested. And hopefully, I ask these open-ended questions for my own investment, but hopefully also somebody maybe that hasn't heard of it before or thought about it before, goes and follows you on Twitter, and it opens up hopefully a good opportunity for them. But I was saying to her that it's a top 15 economy in the world, and they're like still doing these rolling blackouts and sending text message notifications to people and saying like your powers. Yeah, I know.
It's just nuts. I just can't even believe that. Yeah, and that's the joke I use is like, if developing countries are about to go down the renewable and they're looking at how the pilot schemes are going in California, Germany, and South Australia, like I'd be saying, no, thank you. Where's my coal plant where I can get cheap baseload? I don't need this hassle in my life of wind and solar and intermittency and it not working. Interesting.
Fascinating. Well, good to know you like KOL too, especially you said it's a little harder to play. So that's good to know. Let's talk a little bit. Really fun talking to you too, by the way, appreciate it. And, like the casual vibe, but let me ask you, you have like a lot of really awesome, almost like philosophical types of principles to your investments. And I was wondering if maybe you could talk about some of the most important ones kind of as we wrap up a little bit. Love to have you on and talk in more depth about different investments and everything like that. But I figure the last, quarter, whatever, I'd love to know what the top principles that are important to you, or someone like me that's 29 years old, and I know that there are other young listeners as well. What do you think are important things for someone that's investing in commodities right now, and the things that someone that wants to get to the next level needs to know?
Yes, there's a few to go through. I think like I always come back to my mentor's favorite sort of saying that he always rammed into me was just position yourself to get lucky. And well, what does that mean? So there's a few ideas. One is that you want to sort of maximize your margin of safety. And in that is how can you de-risk an investment which has a big upside? And it's quite difficult to do because by default of it having a big upside, it's generally hated. It's generally risky in that it's low on cash. They're not cash flowing. So a good example of that is the offshore space. So these are inherently terrible businesses. They have a heap of hard assets that they've bought with a lot of debt. They marginal producers. So when there's a downturn, they're the first to take it on the nose. And so a way of de-risking them was watching them carefully through the restructuring and bankruptcy proceeding and seeing them pop out with essentially no debt. So you have the likes of Noble Corp, which is going to come out of the proceedings in first quarter next year, and it'll have gone from 3.5 billion of debt down to 350 million of debt. It's reduced its debt servicing by 90%, doesn't have a debt maturity for 5 years. And so something that was highly risky and was a coin flip if it survived, you've now completely turned that around. You've now got a 5-year runway, and you're now aligned with all who were the debt holders are now in a debt for equity swap become the equity holders. So you're aligned. And that leads on to another point, which is aligned incentives. So it's actually huge, especially in the commodity space, because you've got to by default sort of figure that the CEOs are crooks. That's always my sort of baseline. And then I want to be impressed by what I see moving forward, but sort of guilty until proven innocent is the way I go. And with all of them, I've done it a few times on Twitter where I pull apart a few, and I often get a few angry messages behind the scenes, but I just don't want people to get screwed. But yeah, you want to see that their incentives are in line with yours. You don't want to see them paying themselves big fat salaries, paying themselves bonus when all they were doing was turning up at the office. You don't want to see them having secret side contracts. The perfect example I like, or I just use Paladin, is he pays himself a tiny salary, and he's just got extremely laddered performance incentives with options and stock at higher levels. And that's exactly what you want to see. When you see that, you can be comfortable that he wants the stock higher, we all want the stock higher, and that makes for some aligned incentives. And unlike others where it's essentially a lifestyle company, the only thing that I think some of the CEOs are incentivized is to get themselves a yacht. So, and then as we talked about earlier was asymmetry. So I won't enter a position unless I can get a sort of at least a 5x upside. And it's often something that's missed. Like I always laugh when I see people spruiking their win-loss ratio. Like in trading, win-loss really doesn't matter. I could have an overview of a portfolio and see 6 losers and 4 winners, and I wouldn't be any the wiser as to how well that person's doing, because one of those winners could have been a 10-bagger, 20-bagger, and that changes the entire dynamic. And so that's what you really got to focus on, is how to let your winners get away from you and resist the urge to take profits early, yet how to know how to still get out. That's probably the question I get the most, is how to exit well. And that's a really tough one to answer. And then at the same time, it's how to make sure that obviously the losers aren't hurting you. So to practice proper position sizing, 1% or 2 or 3. If you really love a trade, you can push it to 5. But generally, you're always staying within parameters. So yeah, those are a few philosophies that pretty much are the first things I look at and guide how I go into trades.
So position size. So I didn't know, right when I was first investing, I had never heard that. And so I think I was like, it was pretty out of whack. And I learned from someone that I follow closely, kind of, he had a similar parameter as you, was largely 1%, something he really liked. Maybe it was 3. And so that's what you do for instance, on a per holding basis of your total portfolio. So something you said centrist is now like 15% or something, but it started as 1. And that's how you, whether you're long, I don't trade, I long-term hold, but it's all in obviously these volatile commodities. But you do your whole portfolio, and each pick is like 1%, 2%, 3%. So you don't have a pick in the beginning that's 18% of your portfolio or something.
Never,
right?
Never,
Okay.
ever. No.
Okay.
So generally, I do scale into positions. So some positions start off with 1%, which is, I like it. I'll keep researching it. I want to see them executing. I want to like what I see with all aspects of the company. And then if I do, I'll put another order in the market for a price that would make me happy, and then keep scaling in. So there's a few circumstances where I've start off at 1%, and because of how things have traded and I've liked management, keep increasing it all the way up to 5. And at the same time, there's others that I dislike what I see, and so I start scaling out. It's something I can't reinforce enough, is scaling. It should never be binary decisions. Very rarely do I buy everything at once or sell everything at once. It's like I wrote a blog to try and answer the question of exiting, and it was just generally the idea of scaling. Once things start to get a bit crazy, if the taxi driver turns around and asks you what your stock pick is in uranium, sell 10%. If you've mentioned uranium to your mum and she rings you up and says, "Tell me more about uranium," sell 10%. If the coworker asks you about uranium, sell 10%. If you're just sitting in a cafe and look up and it's on CNN, like, sell 10%. It should just always be a gradual scale out. And likewise through this year, it was when really felt the pain, then it should be scaling in. You should generally be doing the opposite of what the market's doing, and that really sets you up for success.
So you don't then, I know you really love pallet, and I just using this as an example because it's one that I know of and common one. So you're not looking at, you said you got in at 8 cents. You're not looking at it saying, if I'm selling at a 10x, I'm selling at a 50x. You don't have a number in mind. it's really an overall feeling of the sentiment of the market is how you determine it when someone says, how do I exit?
Yeah, precisely. It's all entirely sentiment. I do have some factors of which if I see spot just going crazy and jumping right above term, then that would probably cause me to start scaling out. If I see the number of companies in the sector just completely explode, if we go back from sort of 50 odd companies today to 500 companies, then I'll probably take some off if we start getting up around that. And just the other points I mentioned, I've talked to a few friends about it and they've sort of brushed me off. If they start ringing me up, then it's really more of an art than a science. It's the best way.
We're nowhere close to that, though. Yeah.
Oh God, no.
Yeah, right.
But the best way to think about it is we've all been lucky enough to go through the crypto boom. So I don't know about you, but I had that so I've been obviously a trader for years and years. And whenever anyone asked me what I do, and I'd said I was a trader, their eyes would light up and say, "Me too." And I was like, "Oh, okay, here we go." That'd be a crypto trader. And by that December of 2017, I think, and everyone was a trader. Everyone wanted to talk about it at Christmas and New Year's, and it was just so saturated. It was the point at which there was where was the additional sort of marginal buyer going to come from? And that's the point at which you can't be there. You've got to be out. You can accept missing another. It could double again from there against you, but you can't be in that market. And that's where it's nice to have other positions that you think have potential upside that you can be rebalancing out of and into something that you like the upside again, which makes the opportunity cost a lot easier to handle.
So how many positions do you hold, for instance, in like uranium?
I think at the moment I've got my core holdings, which I like to refer to as the sort of the first movers, which are the guys that are generally in care and maintenance that can get into production quickly. And from there, I have I like to call the sort of the out of the money calls, which are a lot of the guys that have higher costs.
Is that like Paladin, which I know you talk about a lot? Where does that fall?
So that's a first mover.
Got it.
As soon as they've just got to bring their mine out of care and maintenance, it'd be hard to stuff that up, which is why I like it. Because people misunderstand me with Paladin as well. I like the risk reward of Paladin buying it super cheap in March. It's very hard to bring a mine to production. But with Paladin, they've only simply got to restart it. It falls within my time frame of when I think the bull market's going to kick off. My expectations were by at the latest it would be sort of halfway through next year, and from there I think that we've let this go so long that it will overshoot, and that's where I go from sort of 5% positions in the likes of some of these first movers to having 1% positions in the likes of like I mentioned before, Forsyth Metals. I don't think that the company will be able to get into production, but I think it will also, people will chase it and there's zero liquidity in it, which will probably skyrocket it. So these are more speculations, and I think those will be the ones. Some of those will have some absolute tremendous returns, but I can't count on them executing. So I wouldn't weight them more than probably 1%. So overall, probably total positions wouldn't even be. I'd have to have a look. We'd probably be 10, possibly 15 max. Yeah, when I count up all the little guys, all the rats and mice. Interesting.
So you just said a moment ago that you expect the bull market to kick off by summer 2021. Is that what you said? And what do you mean by that?
So that's just based on the contracts rolling off. I follow
with the utilities.
Yeah. So follow Mike Elkins super closely, and so he's one of the few people that's modeled out the entire sector, reactor by reactor, and then mine by mine. He knows where every pound of demand is, and he knows where every pound's been produced, and he sees the contracts rolling off far quicker than the market does. And he, based on that, like the market's expectations is that US reactors will be 50% uncovered by the end of next year, which is obviously untenable. You can't have 50% of the US reactors without contracts. And then on top of that, you've got to factor in the fact that when they start contracting, they don't get the uranium straight away. They've got to put it through the fuel cycle, which is something from an 18 to 24-month period in which you have yellow cake from the mine. You've got to put it through enrichment, through you have it made into fuel rods essentially, and that process can take up to 24 months.
And that's where a play like Centrus comes in?
Correct. So Centrus is probably the stock that I've done the least amount of work on, and the fact I just understood it was a monopoly. I can't really read the balance sheet. It's pretty opaque and hard. And the other thing with Centrus that was interesting was they almost got called out on essentially like insider trading with a lot of the senators were going in when they understood the sort of ramifications of 232. So if you understood what was going on there, you could see that days when everything else was going down in the uranium sector, Centrus was jumping up sort of 5%, 10%. And so that was a tip off that some of these guys were buying, knowing well that that was the sort of the direction the US was going to be heading. And so that's when I've just been hanging in there ever since, just knowing that it's essentially got a monopoly on the sort of the technology and a lot of the nuclear space. And I think it's on a good trend in the US, even though I think US is completely behind the eight ball for uranium, not for uranium, for nuclear reactors moving forward. That doesn't mean they won't try.
So is that your top holding? You said that's like a 15% holding for you or something. Is that your top holding in uranium?
I think Paladin might have overtaken it now just because I sized Paladin bigger. But they're both, been one of my better years for performance now. But they're both getting right up there. I think,
cool, man.
Centrus was 3%, and I think I sized Paladin in March. I pushed it right up to 10%. So that was,
cool. Heavy. Cool, man. Well, congratulations. I'm sure you're really happy with having the stomach to get in there and march. I mean, I follow a lot of your picks from AR, and I do Twitter back search because you don't post your picks that much in plain sight. So I do Twitter back search, and I followed a lot of them. So I'm sure you've done really well. So first of all, congratulations on that. And it was really interesting. That's probably you. Let's see. Is that me or you?
For what, sorry? I can't see you.
Oh, I'm getting a weird calling thing coming in right now.
Yes, not on my end, I don't think.
Bizarre. Oh man, that was bizarre. I'll have my editor cut it. It was getting this like ringing, but I don't have this connected to phone, so I don't know what that was. Technical difficulties aside, seriously, congratulations. I'm sure you've had a bang up cleanup job in your portfolio this year, and I appreciate you taking the time to help me learn more and share more. I got some research now to do on Colmore, and I'd love to have you back on and talk more about your updates with your investing and your thesis behind everything. And you also have a really great blog, really detailed. I was reading it and I was like, this guy you kind of have like a Tim Ferriss blog where it's like, it's so much and there's so much charts and there's so much good stuff that it's like, wow, this guy's really got it together on his blog. And you don't see that much in a less of an attention span world, these really great things. So I want to encourage everyone to go to your website. What's the domain of your blog?
It's just traderferg.com. Yeah.
Cool, man. So I always finish every interview. What's one thing that you're excited about or grateful for right now in your life?
I've just been really grateful for this year. So I only joined Twitter this year.
Oh, really?
So it's not even 12 months on Twitter, and I'd sort of avoided social media till now. I've been I'm always an introvert and sort of hide away and do my own thing. And I've got a friend that's like, no, you've got to get in the space. You'll meet lots of good people. You'll build a network, and couldn't have been more right. Like I've tried to put a lot of value out there, and I've got a lot of value back. Like I just really look forward to my DMs. Like there's so many I've met like hedge fund managers have reached out and wanted to chat to me about stuff. Like people have recommended me stuff. And once I've started digging, I'm like, they're spot on with this. Even this with yourself. Like it's just, I wish I'd done it earlier. I've been kind of like trading can be a very lonely game, and I've largely done my own thing for years now. And I wish I'd sort of had this community earlier.
Cool. I love it. All right. Well, everyone, in the description, I'll put Twitter link and all that stuff. So make sure you hit the like button on either side if you enjoy it. Leave us a comment down below or question for future one. I'd love to have you back on, after the holidays and learn from you a bit more.
I'd love that. Sounds good, Jake.
Cool. Well, thanks for everything you're doing. I appreciate it.